Welcome to the Greatest Lessons series. I'll highlight the most important lessons taught by Benjamin Graham by using my longer videos to showcase them. Today's lesson is on margin of safety. And as always, if you enjoy the episode, liking the video, subscribing if you haven't done so already, and hitting the bell for notifications is greatly appreciated. What he's saying is, don't lose money. Being very safe means having a much lower chance of losing capital. Because after all, his disciple Warren Buffett says, rule number 1, never lose money. Rule number 2, never forget rule number 1. With margin of safety, you'll see that there's a difference between investing and accounting margin of safety. Your investments ideally would have both of these. And what is probably the most important of what he's saying is to look for high upside with low downside. The best investors are looking for high upsides and low risk opportunities. Utilizing the margin of safety allows for this possibility. Let's watch a short segment of my longer series on Benjamin Graham. What is the margin of safety for investing purposes? It is to buy below what something's worth. Buying below value means having safety if you're incorrect and huge returns if you are correct. You'll only start buying something between 50 to 67% of the value you feel it's worth. Let's pretend you made a $100 evaluation on a stock and it's being sold currently for $50. If you are correct about your target price, that you feel it's worth $100, over time you are very likely to make solid returns. People will eventually realize the stock is undervalued and you'll double your money. If you are incorrect about your target price, that $100 valuation should have been more like $75. You still make money, and that's really important. To not lose money is a key phrase in investing. Next is the what is margin of safety for accounting purposes. And this is from a lecture quote in 1972. The margin of safety is the difference between the percentage rate of the earnings on the stock at the price you pay for it and the rate of the interest on the bonds. And that margin of safety is the difference which would absorb unsatisfactory developments. Benjamin Graham really hated losing money. That's because he was a really good investor. When picking stocks, it's good to have the margin of safety on both ends. Accounting margin of safety, the company end, the investing margin of safety, going from the investor's end. For the company end, do they have a nice cushion if earnings drop for whatever reason? If not, bond payments might require assets from the company to be sold to meet demands or to lay off employees. Investing without a margin of safety in the company means possibly huge consequences. As far as the investor end, is your evaluation correct or not? If you used a margin of safety, then yes, you get huge returns. No, then smaller returns or less damaging losses. Low risk with possibly high returns is what you should be shooting for. Think of it this way. Imagine building a bridge that needs to hold 100,000 pounds for multiple trucks to pass through. Would you really only make the bridge built to support, at best, 100,000 pounds? No, you'd go higher and be on the safe side so no issues would arise in the near future. We built the bridge to support a maximum of 100,000 pounds. My cargo plus truck alone weigh 100,000 pounds. So what's the issue? I weigh 180. Thank you so much for watching to the end of the episode. And if you're interested, consider joining with the Market Moves Investing Book Summaries link in the description down below.